I come from a trading background as a trader and someone who's had some pretty good trades. In 1995, I was president of Toronto Trust Argentina in Buenos Aires. It was the world's best performing emerging market mutual fund, #1 in the world. So I've been there, done that. And my sense as a trader is always, I want to look at the direction of things. The magnitude, I'm not so interested in. I'll worry about that later, if you know what I mean. So somebody asked me, I happen to be a bull on gold. I have been for a long time. So somebody says, oh, where's it going, Hanke? Where's your target? I have no target. It's just in a bull market, I'm long, and it's going up. And the trick is, when I say get the direction right, that means to get the turning point right too, because that'll be the change in the direction. If it was 1929 and the money supply was contracting by 38%, I'd say we're going to have a hell of a depression and it's going to last a long time. We don't have that kind of thing. Right now, we have the stock of money being lower than it was in the summer of 2022. But the growth rate in the money supply, it's anemic. It's 3.9%. It should be, to hit the Fed's inflation target of 2%, should be about 6%. So that's the context for the whole thing. We've had the stock come down, very unusual, only 4 times in history since the Fed was founded in 1913. And we've had this anemic growth. It still isn't growing at 6%. Right now, the consensus for profit growth in the stocks is about 25% of profit growth. I think with the slowdown coming and so forth, I think we'll probably see 5%. That's how you think. If you had a business and you were thinking, oh, I'm projecting, the profits are going to go up 25% this year, and all of a sudden Hanke comes in and says, oh, they're not going to be 15%, they're going to be 5%, what would you do? You'd be a little careful. That is, if you believed Hanke. Maybe if you didn't even believe me, maybe you'd start scratching your head and say, I don't know if the guy's right, but maybe there's something to what he's talking about. Maybe I'm going to dial back to 7.5% growth rate instead of 15. And what you do, if you're running a store, you don't load up on inventory. You keep it, thinned down, that kind of stuff. My problem with the Fed is that if they have a model for anything, it's not the right model. And the only model that's relevant for money in the Fed, central banks, is the quantity theory of money. They've totally dismissed it. So what model they have are a lot of post-Keynesian models, actually. And those models don't actually include an aggregate for money and the money supply. So can you imagine a central bank that has a model of the economy that doesn't include money? That's what they're responsible for producing. The product they're supposed to produce is money. And that's why, by the way, they came up with all these ad hoc reasons for why we had such an inflation we had in 2021. Remember, it was the supply chain glitches and it was temporary and all of this stuff. They were never able to predict anything because they didn't have the right model for anything. Okay, here's the effect. You asked about the income inequality. How does it work? We know that with big changes in the money supply, the next thing that happens with a lag of around 6 to 9 months, asset prices change. And what happened? They goosed the money supply in February of 2020, and asset prices zoomed. The stock market went way up, real estate prices went up, land values went up, all the big asset categories all went way up. Now, who owns assets? Rich people own assets. So the rich made out like bandits. The lower income strata, they don't own any assets. If you look at their balance sheets, most of them are actually in debt. So if you look at right prior to the goose and the money supply, U.S. billionaires, their wealth as a percent of GDP was 14.1% of GDP. Now what is it? It's 21.1%. The billionaires made out like bandits because of the Fed. The idea that there's some fixed group, and there's some conspiracy or something. It's basically nonsense. There's a huge amount of churn in the economy over the generations. a lot of people who are down at the bottom, they have children, and those children actually go way up. And a lot of them who are way up go way down. So this is the beauty of a free market economy. This is the result of a free market economy, the churn. So that's one point. The other point that I'd like to make is that Matt Sakurki and I have a new book coming out, Making Money Work. One of our big things is that the Fed, in terms of their policies, they should be focusing on neutrality, trying to make monetary policy as neutral as possible so that we don't have these big biases coming in. It's not neutral now. I just gave you a perfect example of non-neutrality. And this gets into something, of course, that I'm opposed to, and that's crony capitalism. The insiders that can lobby, the friends of the president and that kind of thing. And every president has friends. And the last two, by the way, have been, it's pretty blatant. Why do you think the members of Congress do so well in the stock market? So the Fed embraced and learn the quantity theory of money and try to keep the broad money growth in the United States around 5 or 6%. Instead of, that would get us off this roller coaster thing up.
Okay.
So that's the Fed. So that's very important, by the way. And the full new mandate of the whole thing is laid out in Sakurki and Hanke's new book, Making Money Work. That's the whole point of the book, is to make the whole financial system work better. And part of that book, it's not just the Fed. Remember, most money produced in the United States is produced privately by commercial banks. And commercial banks, from 1945 until the Great Recession, their assets were growing at about 7 to 8% per year. Since the Great Financial Crisis, they've shrunk way down. They're only growing at 4.4%. We want to get them back at the center of things. Why have they been squeezed out? Well, you had, remember the Great Financial Crisis, the boogeyman, where it was the banks and bankers, and you had Dodd-Frank come in with all kinds of strangling regulations on banks. That was one thing. And also at about the same time, you had Basel III come in, which increased the capital asset ratios of banks. That squeezed them down. And then you had Fannie and Freddie, government-sponsored agencies now. They were nationalized in 2008, and that's created a little bit of a sucking sound on deposit-taking banks. So we've got to get banks back at the center of things. That's part of the quantity theory of money. So how do you do that? It's bank regulations are a big part of monetary policy. Most people don't think that. They think the meetings of the Federal Open Market Committee are the one and only thing that determines monetary policy. It's nonsense. Bank regulations, they don't change very often, they change slowly, have a huge impact on the growth and stability of the money supply because of what? Commercial banks. 76% of the money supply measured by M2 has been produced by commercial banks. A bank loans Steve some money. What does that do? It goes into Steve's checking account. Checking accounts are counted as part of the money supply, M2. And it's fiat money. It's created out of thin air, but it's underwritten by commercial banks that they're making the loan to you because they think you're going to put that money to productive use and there'll be some surplus generated out of it. And oh, by the way, your factory where you're going to be producing that surplus will be collateral for the loan. They're not only producing money, but the banks have a direct link to the real economy. The other reforms, I just go back to Reaganomics. You want to deregulate the economy as much as you can. And I would also reform taxes, get rid of tariffs, free trade, a flat tax. Everybody pays 15%. That's it. You send in a postcard every year. That's how you file taxes. The bull market is in gear, and some people ask me, well, is it a young or an old market? I don't know. It's just going up. And by the way, the regime uncertainty is playing a big part in this now. The new element, these new highs that we're reaching, the regime uncertainty, because President Trump, he announces a tariff one day, then he takes it off the next day, then he adds another one. It made the all-time high thanks to Trump yesterday saying he was going to put a 25% tariff on foreign automobiles that were imported into America. The underlying factor for the current bull market has been purchases of gold by central banks. So as many enemies as the United States is making now, and the way the United States has weaponized the financial system with sanctions, that isn't going away. That's why the foreign central banks are buying. China's buying big time. Russia's buying big time. Private Chinese have been buying too. That's been a factor. The underlying fundamentals, I don't think, are going to go away, even if the regime uncertainty aspect cools off. But the regime uncertainty, by the way, might not cool off. That hypothesis might not be correct. With the New Deal and Roosevelt, it just kept going on and on and on. I mean, and you get this, by the way, you can see this because remember that CEOs who just have their finger in their wind, they're not thinking about any of this geopolitical stuff. Remember when Trump came in, all of a sudden they became buddy, everyone got on board. Now they're becoming scared. They're backing away. So that's what happened with the New Dealers. I remember also the slowing economy, the rate of growth and profits coming down will be much slower than the consensus. So I think Buffett more or less has things right. He's got Berkshire 27% cash, and he's liquidated all these long market ETFs. He didn't have much, but he got rid of them. And I think the market's overvalued, overpriced, and overhyped. And Hanke's bubble detector is in bubble territory. So I wouldn't be surprised if we had a 15 to 30% correction in the market.